Hello, I'm Sean Richards of Not a Yes Man's Economics. What I'd like to talk to you about today is a change in central bank policy and to some extent maybe even philosophy. What I mean by this is that central banks around the world are having to come to terms at the minute with something they don't like at all, which is that we've been seeing for a while now an economic slowdown. Some people are saying this will become a recession. Now the truth is we don't actually know that. That may or may not be true. But what is clear is that the world economy is seeing quite a bit of slowing. For example, China. There's been a litany of measures coming out showing slowing there. This very morning, actually, just under an hour ago, in Europe, industrial production numbers were weak. And actually people were already expecting them to be bad. They were weaker. This has left central banks in something of a quandary because they've been going around saying to people that they're going to normalise policy. What they mean by that is raise interest rates. Usually there's a specific number that they're aiming at there, and also reverse perhaps some of all the quantitative easing bond buying they've done. But if we stick with the interest rate points, you needn't worry about what level they're going to raise them back up to, because I think that game's now over in terms of central banks raising interest rates. For example, another piece of news this morning from the Riksbank of Sweden, mostly hot air out of them because they've raised interest rates into the slowdown, which is, for those that followed the Blackadder television series, one of Baldrick's ideas of a cunning plan. So I suspect they'll be quiet for a while. But coming back to the other central bank point, last week there were quite a few hints out of the US Federal Reserve, and particularly from Mary Daly of the San Francisco Fed, that they're now actually discussing quantitative easing again. And this is a sort of like road to Damascus type conversion for central banks and the Fed on two counts. One is the Fed's supposed to have been going the other way, tightening policy, and yet so quickly it's talking about re-easing again. The next is, can they ever break this cycle? I've called this before a type of junkie culture. And what I mean by this is easy monetary policy. Well, what happens next? People then tend to borrow. You lower interest rates, bond yields, for example, mortgage rates get lower. So you encourage higher house prices. People then need lower mortgages and so on. Some impact of that happens with companies too. Not so much in the same way as mortgages, but you get things like zombie companies that really only survive because they can borrow so cheaply. Another version of that, actually, because in my opinion it runs on like a cash flow model, is the shale oil industry. That in essence gets money in cheaply, then can pump the oil, and is less bothered about other calculations, profit and loss, balance sheet. But the trouble is, each time you keep doing this, and then you want to boost the economy, you've got to do more next time. And this is the junkie culture thing, the trap, however you want to put this, addiction, that now they're openly saying they can't break. Now they're not so much, saying it exactly like that, but the implied view is that they can't break, And now, what will they do? Because we see something like the US Federal Reserve already with a balance sheet over $4 trillion US dollars. Is it going to keep expanding like the Bank of Japan? If we move to Europe and consider the position of the European Central Bank, this is especially awkward. As I started by saying earlier, that industrial production in Europe has been particularly weak. Well, it's just ended its stimulus program. So that leaves in a very awkward position because a U-turn now would be embarrassing. But let me assure you, if they hadn't just ended it, they'd be starting one. This sort of situation, a lot of central banks are finding themselves in. So I've covered America, United States, Europe here, all facing that sort of situation. And I'll finish up by looking at my home country, the UK. The Governor of the Bank of England is promising people limited but gradual interest rate increases, when in fact it's vastly more likely he'll cut them, looking at 2019 prospects. And we could even see QE bond buying start again in the UK. That's one of the reasons why UK gilt yields is so cheap. 1.19%. It's a market now I've followed for nearly 30 years. And that's an incredibly low level, ultra low, and it's hard to say how low that is. Why? Well, because they expect more. And that's the prospect for 2019.